And welcome everybody to the PCS Like a Pro show. I'm Megan Harless, your host as always. And we've got a great show for you today. We're going to be talking about everything you need to know in utilizing your VA loan and buying a home, especially if it's your first time buying a home, and everything you need to know about that. Before we get into it, just a couple announcements we want to give everybody. First, if you haven't seen it, I'm going to drop the link into the comments because I'm excited about it. But our store, the PCS Like a Pro store, now has shirts. All your fun and favorite PCS sayings. Like we have some kid shirts that say "Do not pack" because you don't want your kids getting packed in the box. Or one, which is PCS and coffee, because I feel like every PCS, I mean, especially our pack days and load days, you just kind of need like a coffee IV to keep you going. So we'll get that link dropped in the comments for you to go check them out. Lots of different color options and things to go with it. But if you got a PCS coming up, make sure you go and grab yourself a shirt to wear during the crazy hectic days. As far as DoD updates and things you need to know about is that if you have orders and you are sitting on your orders trying to figure out when you're going to move, when you're going to set up your move, you need to log into DPS right away and start getting your move set up and established in the system. You want to give your transportation office time to find a TSP, a moving company, to take your shipments, and to give that moving company time to plan your shipment and your move as well. There are some locations we're hearing are already booked solid until mid-July. If you're in Washington State, California, some places in Kansas or the Dakotas, you want to make sure that you are being able to get the dates that you want as well. If you find yourself in that situation where they say, hey, we don't have movers available for you, you have a couple of options. One, you can either do the Diddy move, the PPM, where you move yourself and you can be paid for that, or you can pack your stuff and put it in storage and let it sit there until they can get a moving company to be able to come pick your stuff up out of storage. Or option C, a lot of people don't like this one, but you can also do split travel. You can send your service member on ahead, let them be able to check in, report, the family stays behind until you can get movers assigned and then pack up and handle your move that way. But if you've got orders, you're sitting on your official orders, and you don't have your move set up in DPS, you need to do that immediately to make sure you get your shipment in the queue. But if you're planning a PCS in June and you haven't set up your move, you might want to go talk to your transportation office, because we're seeing some of those delays starting to happen already this early in the peak season, and we're not even into June yet. So go get that done. And we're going to get right on into today, because I'm very excited about today. It's going to be very informational for you. It's a lot of stuff that I didn't know and I've learned over the last few weeks as we were looking at possibly buying a house. And so I figured if I don't know it, there's a good chance a lot of other people don't know the information as well. And it's things that they need to know about. And so with us today, we have Michelle Crumley from Caliber Home Loans. So Michelle, welcome to the show. I'm glad you're here. Can you just take a moment and tell us about yourself?
Absolutely. And first of all, thank you so much, Megan, for having me in Caliber here today. I am a 30-year military spouse. So I've been through a couple of these PCSs myself. The biggest and longest distance one was from Virginia to Kodiak Island, Alaska and back. Always fun. And then also I've got 20 years experience in the mortgage industry. Got started in a small rock, Kodiak Island in Alaska 20 plus years ago now. And have held all different kinds of positions. And as that military spouse, it has always been focused on our military family with that kind of specialty on VA lending. And I've held positions from branch manager to originator to performance coach for our mortgage folks, as well as a national trainer when it came to our loan officers in VA lending. And now I get to wear my cap here I call it my superhero cape here at Caliber. I'm the military lending for both the military community as well as the client, that military client. I'm the liaison really for us here at Caliber and the individual in the communities. Spending all of my time doing things like this, educating, whether it's educating our loan officers, our mortgage industry, our real estate industry, or one-on-one in our communities, and just absolutely love it and love these opportunities.
No, we're so glad you're here. And I see a couple of the comments coming in from Dustin and Sandra joining us. We're glad you guys are joining us today. So let's just dive right into everything that we need to know about all of the things in the VA loan and buying a home. So
how much time do we have?
I mean, we could be here for a while, I guess. But before we get into like actually using the VA loan, can you take a look into your crystal ball and what is this housing market that we're looking at right now in terms of like interest rates, housing inventory? What's just an overall picture of what we're seeing right now?
So there's good news and bad news on that front. We'll start with the bad news first. You always take, the medicine with something that tastes good, right? So we'll start with the medicine. So we know that interest rates have been on the rise. When you turn on the television, when you're listening to the financial news, when you're seeing what's happening in the world and the financial markets, we are seeing that, right? Interest rates are rising. And they've been right. They rose very fast, especially the first 3 months of this year. And I will be honest, at this point, the crystal ball shows that as long as the Fed is really trying to curtail inflation, they are going to be continuing to raise the Fed funds rate. And as they do that, it has additional implications in the bond market and the mortgage-backed security market. So for the foreseeable future, we do not see rates coming down. We see them in actuality continuing to tick a little bit upwards. It's going to be likely when there's that hint of recession on the horizon that the Fed backs off. Recessions are great for mortgage rates typically. So at the moment, from a rate perspective, we aren't seeing any real relief there probably until next year. Now, if we get inflation under control, if everything settles down in the world, if the markets all shake it off, we could see it earlier. But really, just as we are guessing, because it's all guessing, where the Fed goes, where the world goes, at this point, the short-term expectation for the rest of this year is that we will see rates hold and increase, continue to tick upward as the Fed makes their moves. On the flip side, with the increase in rates, we are starting to see some cooling off, some of those initial indications that the housing market may cool off a little bit. Cool off does not mean we're in a bubble that it's going to break, that values are going to fall. No, what we're talking about with what we're seeing is that the rate of appreciation is starting to slow down. So where we were seeing the prices month over month, year over year appreciate 10, 15, some 20, 30%, we are starting to see that percentages drop a little bit. So there's still appreciation. It's just not happening as fast. We expect it to continue to be a really strong mortgage property seller's market. But we are excited to see that while it is a seller's market, it's not going to be as chaotic as likely it's been. So as the appreciation returns start coming down a little bit, not that, again, they're in negative numbers. We're seeing, again, that just the amount that it's appreciating reduce a little bit. We're also seeing how long properties sit on the market is increasing just a little bit. Mm-hmm. Now, pre-pandemic, pre-2020, they were on the market 34 days on average. Last year, it was half of that. And now we're seeing it take a little bit longer. So a house may stay on the market a little bit longer, a few extra days, a week, maybe more. And when that occurs, then the sellers are more apt to look at all offers, or maybe take a offer that was at their original price, not expecting it to come in 50, 75,000 over value. And then we're also seeing the inventory. So pre-pandemic, or even early 2020, we were seeing to where we are today, for every 5 houses that were on the market in 2020, there are 2 today. So that inventory has played a huge component in the increase in the values as well. And while we're seeing inventory is still very tight and is going to remain tight, we are starting to see again, as the number of home buyers drop, as the length of time it stays on the market, a home stays on the market, we're starting to see those inventories maybe sneak up just a little bit. So the housing market is going to remain strong, but it should not. We are moving away from that crazy frenzy that we saw last year. It's still going to be tough. You still need to go in very well prepared. And we'll talk a little bit about that as we talk about the loan aspect of it and planning for that. But I think that with proper planning and expectations and time on your side, you're going to be much more happy with the market that you're going to see the remainder of this year going into next year than we were experiencing last year.
Yeah, no, absolutely. And so just for everyone that's just now joining, I mean, we should not expect there to be a housing market crash happening later this year or early next year, any time like that, correct? Yeah. If you guys were like me, we're like, a couple months ago, we're just like preparing for our PCS, not able to find a house. We're just like, maybe we need to buy a house. And we started going through the process of looking at, buying a house and everything. And there was a meme floating around. I'm going to find the picture. We're going to get it posted in the comments. But it was like a couple of houses and little stick figure guy there with like a stick, like poking the house saying like, come on, crash. Like that was me. I was just like, can we turn this around? Like, I don't want to spend that much. Like, if we have to, we will. And while it was funny, all my friends that like had just bought a house or were planning to sell their house, they were just like, please don't. Like, stop.
It's a double-edged sword, right? One of the parties, whether you're the seller or the buyer, is happy. If it's a seller's market, your seller is in seventh heaven, right? We want it to stay a seller's market. When you're trying to buy, you're like, okay, no, I want the values to come down a little bit. I want those things to occur so that it's an easier entry point. We want to find that balance.
Yeah, balance is definitely good. I could settle for that. I was definitely like on that team, like, please crash, like, please, like, tomorrow something else happen. And of course, nothing ever works out my way.
Murphy's Law.
But so now we've put off buying a house because some things have changed in our plan of our timeline of things. And so now I'm just like, oh, we have more time. Like maybe by the time we go to buy a house next time, it'll even out and it'll be good. Maybe that's my working out thing. So I want to start, getting into this process as a first time buyer to walk through some of the basics. So I know I want to buy a home. What do I need to be doing first? I can't just go pick on a home and say, hey, this is the one. Like there's stuff I need to do before that, right?
We absolutely prefer that because you want to give a loan officer heart palpitations. That's the very first time that you talk to them. Hi, my name's Michelle. I've already got an offer on this house. I'd like to get qualified. That's not the way, ideally, we want that conversation to go. In fact, what I will tell you is that it is the perfect scenario if you think you are going to be in the market for a home in a year, within the year. It is not too early, a year out, to start having conversations with a lender. Now, you're going to want that lender to really understand the military and veteran world. You're going to want them to know what a PCS means, right? So you're going to want them to be an expert. You're going to want them to have that knowledge of our community, that knowledge of what a PCS is like, and then also to understand and be an expert in military and veteran lending, the VA loan, other loans as well, in the event that the VA loan isn't the right one that time. But there are enough nuances when it comes to that VA loan that you're going to want to make sure you're talking to an expert, both the lender as well as the company that they work for. So the loan officer and the lender being an expert. And then the earlier in the process, again, if you are a year out, it's not the time that you're going to be making a full application to go house hunting. You're not there yet, but to really start understanding the process. figuring out, okay, this is where I'm at today. This is what I want. Then you've got plenty of time to make whatever changes or modifications to get you to exactly where you want to be, that give you more options and choices. If you wait till you are 3 months from wanting to be in a home, so ideally at that point, you need to be pre-approved and house hunting, right? So that you have that opportunity to close and be in the house in that time frame you want. It doesn't give you a lot of time if you need to save a little money, if there's a debt or two that you want to pay off so that you can afford more. So I would tell you, it is never too early to start having those conversations. My perfect scenario is when I get the opportunity to start educating and working with a client a year ahead of time, just to get to know each other, to get to know the process, to get to know what to expect, and to educate on loans and lending, as well as moving and real estate agents, and really kind of getting your team all built so that when you get to that 3 to 4 month mark and things want to get and need to get hot and heavy, you're ready and you are there confidently, not trying to play catch up at that time.
Yeah, no, absolutely. And it's something like, it's okay to shop around for different lenders too. If you talk to one and you feel like it's not a fit, they don't really know military life, understand, like, it's okay to go talk to another one and start the process with them too, right?
Oh gosh, absolutely. So a lot of times, right, we've heard, go shop your real estate agent, always interview 3 agents. I'm going to tell you to absolutely do the same thing on the lending side. Not all loan officers or lenders are created equal, and not all are your personality or that will work well with you. So it is a relationship, and with the right lender, it's a relationship for life, right? It's ideally, hopefully, that individual that you get to know, that you work well with, that you know is an expert, that then is there to help provide guidance and counsel and that information and education all through your different moves, different reasons for purchasing, selling, refinancing. You really absolutely talk to lenders, find what works for you, make sure that they're experts and that they understand the community. That'll be my one big caveat. And then make the decision from there.
Yeah, no, absolutely. We got a comment here from Destin about that similar thing. That first thing I do when we get orders is start looking at homes and interviewing agents to find one that fits with our family. I think having that good fit definitely makes a big difference in the process. And if you're someplace and you're not exactly sure who to reach out to, I'll say our spouse groups are amazing resource. Our local spouse groups, you can ask in there who has recommendations on a lender, on a real estate agent, on a doctor, you name it, you can ask it in there and you'll get all the recommendations of who to use and who not to use, so you can get a good idea of, what's working in your area. I mean, of course, we love Caliber. I can tell you, if you don't know Caliber, they have their own little military team of lenders who are, affiliated with the military in some form or fashion, but work specifically with the military community and know all about the VA loan. So they're not having to be like me trying to Google stuff and figure out, what's accurate, what's not. They know the stuff.
Well,
I'm very good at Google, but sometimes Google is not the greatest rabbit hole to go down.
It's too vast in some cases, and it won't get you to some of the heart of what you're looking for in many cases. And I love Destin's comment and 100% agree with that. And I would say, even before you get your actual orders, be having the conversation with the loan officer if you think you're going to be buying. Again, being ahead of that curve so that you've got that kind of thought process all lined up at the point that then you're starting to talk and interview real estate agents as well.
Yeah, no, absolutely. So when we go through the process and we get into everything, it can often feel very intimidating and having to show all the financial things. I know I had discussed this with you. It felt like very revealing of like, here's my dirt in a way. Like this
here I am naked in all my glory.
Right? It's like the little dust bunnies under your couch that you don't get swept up all the time, and now you have to like move your couch and show the world the dust bunnies you didn't sweep up last time. So going through all of this, how does your debt to income ratio play a role in using the loan or getting the loan? If using a VA loan, how does your credit score play a piece into that? And like other accounts that we may have, like if we have other Roth accounts or retirement accounts, investment accounts, maybe we're not using that money to pay for the home, but we have them. Do they play a role in supporting how much of the loan we can get?
So those are great questions. And the answer is to that, all of that is important. So let's talk about the first thing that I think you mentioned was debt to income ratio.
Yeah.
So let's dig into that a little bit. And for those that may not be quite as, have had a lot of conversations about finance, that debt to income ratio really is taking a look at how much money do you have that's coming in the front door that can be used for buying a house. There's some income that can, there's some income sometimes that can, and then there's some income sometimes that can't be used in kind of figuring out what you can afford from the lending side. It's great that you have it. It just can't be considered as qualifying income. So we're going to take a look at how much money you've got coming in the front door. And then we're going to take a look at how much money you've got going out the back door, right? So we're going to take a look at how much you owe others. Like, so from your credit report standpoint, what are the debts that you owe? Who do you owe them to? How long are you going to owe them? And what is that minimum monthly payment that you have to make? We're going to talk about, do you have childcare costs, formal childcare, whether it's before, preschool, whether it's daycare, whether it's after school care? Are there childcare costs that are going to impact your monthly income? Is there child support or separation maintenance that you may owe others, right? So we're going to take a look at how much is going out the back door. And that's going to tell us then how much income that you have in what's called a debt to income ratio. So again, how much debt do you have to the income? And what VA says is ideally they'd like that to be at 41% or less of your income be used to buy a house and the rest of your debts. Okay, so that monthly payment for your house plus all the debts that you have, they would want that to take 41% or less of your income. You can go higher than that when you have some compensating factors. And a compensating factor might be that you've got a really high, solid credit score. It might be that you've got other income that we aren't able to use because of the type of income it is, but we know that you've got that would increase your ratio if we could use it, right? We know about it. Maybe you've got a side gig that you've had for a couple of years, but you haven't documented some of it as well, or you haven't done it for a full 2 years. So we can't count the income, but you've got that income, right? Maybe it's your amount that you are buying, your payment, what your monthly payment's going to be, is at or less than what you were paying for rent. So there's not this mortgage shock, this payment shock that you go from a rent of $700 a month to a $2,300 a month house payment. That's called payment shock. And that's not a compensating factor. That's something then that we have to compensate for in many cases. So it's finding those things that strengthen an application. So the debt to income ratio is important. And that's where then starting again a little bit earlier in that process in talking with a lender about, here's my income, what it is today. Here's what we expect it to be 6 months to a year from now. We can talk about types of income, especially if you're transitioning out of the military, the complete income differences on what can and can't be used and when. So we want to be able to have those conversations so we can plan accordingly. So debt to income ratio, very important. Credit scores. You had asked about that. So with
Yes, and I was just saying credit scores. Yeah, it was a credit question.
So credit scores, what's really interesting is the VA does not mention anything about a minimum credit score requirement. They don't. But your lender whichever lender it is will have their own overlay that will have a credit score minimum that company generally allows. Usually that's around 620, 600. Some like Caliber will go down to 580, but just remembering that a credit score is just the indicator. It's the numeric expression of the health of the actual credit. Who have you owed? Have you paid on time? Have you been delinquent? Do you have judgments or tax liens? Do you have collections that are out there? And how long ago are these? It's that information, which every loan is going to consider, that generates that score, those scores for the different credit bureaus. And then that score is one component of the qualifying parameter, but it's really the health of the credit that's going to be the main driver. Does that answer the question on scores?
Yes, it does.
Okay.
And real quick, before we get to the last half, there's a question here from Dustin. Dustin, I may need you to help clarify. It says, with that income you're talking about, like my husband's income and me being a stay-at-home mom, but with bringing in tax-free VA disability. I think when you were talking about income that can be used, qualifying income towards purchasing the home versus that non-qualifying income, you still have it, but it doesn't count towards purchasing the home. So the husband's income, active duty service member, that income counts, but does that VA disability payments also count towards as qualifying income? Or
so absolutely. So let's say, Dustin, if you are currently a stay-at-home mom, but you were in the military and you are receiving VA disability, yes, that VA disability, because it's documented and is going to continue forever, that absolutely can be used. Things that can't be used, things that you can't document. So if you're paid under the table, great for you, but that can't be used. If you are a seasonal employee, but you don't have a history of being a seasonal employee, you haven't. And when we talk history, we usually say we want to see 2 years. If you've done something for 2 years, chances are you're going to continue doing it. So maybe you've started driving for Uber or Uber Eats or Lyft, got a little side gig going, but you've only done it for a year and it's sporadic. There's no guarantee that that's going to continue. So that income would be like, okay, that's great that you have it, but we can't use it for qualifying. If you are receiving child support and that child support that you are receiving ends within 3 years, that child support wouldn't be able to be used. Same thing with alimony. If you're going to be receiving that alimony for the next 3 years, you could use it if you wanted to. If you're not going to receive it for the next 3 years, it's not continuous. GI Bill is another one. That's in a stipend that you're receiving while you're going to school. Great that you receive it, but it's not something that can be used for qualifying because it's tied to you being in school. So you've got to keep your grades up. And if you decide you don't want to go to school anymore and you drop out or they kick you out, all of those things that can happen, that means like the GI Bill itself, any income from it can't be used. So it's identifying the income, can it be documented, and how long have you received it?
Yeah, no, that all makes sense. Just what Dustin said there. So that, I think that was a great breakdown as to what is qualifying versus that non-qualifying. Definitely a good question that you asked there, Dustin. Thank you for that.
And while we're talking about income, so I mentioned transition. The one thing that I would throw out there is if you are getting out of the military within 12 months, whether you are retiring or whether you are transitioning out, you're choosing to leave, or you've had a service-related disability and they're letting you leave, or they're telling you you're leaving. For whatever reason, if you are transitioning and you're doing that, within 12 months of when you want to close on a house, your active duty income cannot be used for qualifying purposes. And that is because there's an end date in less than a year to that income. So then we have more opportunity to have conversations about what's going to need to be in place and when it can be in place and what's going to need to be documented to be able to use income from another job that you might have after you get out. So just know, if transition is part of your plan, or as you're thinking about buying a home, definitely start having conversations early about what's going to be needed and when, and what can and can't be used, and how to plan for that accordingly.
Yeah, no, absolutely. Good tip there. We see that a lot in the groups of people not realizing, we're retiring, we're moving from Kansas to Florida, they want to buy a home, their forever home, and then realizing like they maybe can't buy it right away because they just had their retirement paid. They don't have the next job set up yet, or they have a break before starting the next job, or they don't know if they want to work yet. They want to go just hang out and maybe go fishing for a while. And so I think, a lot of people they don't realize that they need to have some sort of documented longevity of income of some sort.
Yeah, the government wants to know that you can make that payment for, forever. That you have the means, the ability, and your credit history shows that you will, right, make your payments. So all of that becomes important, and we have to show the government that.
Yeah, I mean, darn government always, messing up our plans with all of that. And then the last part of that question was about like having those other like investment retirement accounts. Do they count? I mean, if we're not I think they would fall under that non-qualified income piece because we're not pulling from them to pay for the house. They're just
those are your assets, right? So those are what we would consider your liquid and your non-liquid assets. Mm-hmm. And they play a part in a couple of different ways. So when we take a look, and whether we're talking checking, savings, investment accounts, retirement accounts, brokerage accounts, TSP, IRAs, any of those, sometimes there's a little bit of a misconception that, that like VA is 100% financing, which means in many cases, you don't have to make a down payment. In most cases, you don't have to make a down payment. However, there are still closing costs that are part of that transaction that are owed at the closing table. So
those cannot be financed into the loan. They have to be paid out of pocket.
Yep. On a purchase transaction, always. VA will let you roll in the VA funding fee, which we'll talk about in a minute. But all of the other fees and costs have to be paid at the closing table. And a general rule of thumb is about 2.5% to 3% of your purchase price. If you've planned for that for closing costs, you should be fine. But that's owed at closing, whether you pay it, whether it's a gift from a family member, whether it's paid for by the seller. There's different ways that can come around, but they're your costs that are owed at closing. And then it's working with your lender and your real estate agent to determine where those funds are going to come from. Okay. But so you're going to have some assets that you show and that are verified that will cover your costs. Then there are the rest, right? So if you don't have to put any money down, then there's the rest of your assets. So if let's say you've got, $50,000, $60,000 in a retirement account, you don't need it for the transaction because it's 100% financing and you're not putting any money down. You got plenty for the closing costs. It strengthens an application. It shows that you've got money available in the event that you had to replace a roof, money available in case, you were out of work for a month or two, that you had a nest egg that could help cover costs. What it will also allow you to do is, if you find yourself, it's the time to buy, you've made good decisions, and you have decided that you want to pay a little above and beyond what the purchase agreement is for. So if purchase agreement was for $200,000, but you've agreed to pay $205,000, it gives you that flexibility because you've got the cash to cover that difference between the purchase price and the amount you agreed to pay. So it gives you options and flexibility, and it will strengthen an application and be one of those compensating factors if your debt to income ratio is a little on the high side.
Yeah, no, absolutely. I always feel like when you get to that part of the application where it's like reveal your financials, there should be like a comment box on there where we could be able to say like, I was a very bad young adult financially, but we've gotten better over the years. Or like my car completely, crapped down on us last summer and we had to unexpectedly get a new car, but otherwise we are a responsible adult. To be able to help explain some of those things, like I said, it always just feels intimidating, but being able to have somebody like Michelle that can sit down and explain those things and help you walk through the process and make it not feel so intimidating definitely goes a long way to kind of get through it all. Because I was definitely like, why do you have to see all of this, like, but she made it so easy and so great. So let's talk some more about like the VA loan in regards to disability, because this is one of the questions that I had asked you. I was like, I have a VA disability rating. I've heard I can use it for something with my loan, but I don't know what. Like, what is this thing? What does it do? So if a couple is buying a home and one is a disabled veteran, how does that impact the use of that VA loan?
So the VA is self-funded. So here's the great news about a VA loan. If you don't use the VA loan, your taxpayer money is not going to fund the VA Guarantee Home Loan program. It is self-funded, and it is done so through the use of the VA loan and the VA funding fee that VA charges to active duty and veterans when they use their benefit. So there's this fee that's out there, and depending on whether you're a first-time user or you're using your VA for a second, third, or fourth time, so that at that point you're a subsequent user, there is a different fee calculation that goes into that. First-time user, it's 2.3% of the purchase price is that VA funding fee that can be rolled into the loan. And as a subsequent user, it's 3.6% at 100% financing. There's ways to mitigate that a little bit with a down payment, but just we're talking 100% financing at this point. So there's this VA funding fee, which is what the military community pays so that the VA can offer this program of 100% financing, no mortgage insurance, lower rates in general than conventional loans. With that in mind, there are 2 times that VA funding fee can be waived. And the first is while you're active duty, if you have a Purple Heart. If you've been issued the Purple Heart, you have your VA funding fee is waived for life. Okay. The second way that VA funding fee is waived, you're exempt from it, is if you have a disability rating greater than 0. So today, VA says, if you have gone through your medical screening and you've submitted your claim to the VA and the VA has approved your claim and they've told you what your rating is, as long as it's greater than 0, your VA funding fee is exempt for life.
And before the question comes up, because this was my question too, is like, so in my household, like I have the VA disability, but my husband's the one with the income right now, being an active duty service member. And so it was, the question I had asked Michelle is like, can we use my VA disability rating with his qualifying income to be able to get that piece waived? And the answer was
yes. It is all we have to do is make sure, one, right, do you have VA loan benefit eligibility? So do you have the right and the ability to use the VA loan program? Okay, great. Yes, you do. Perfect. Then from there, it's taking a look and saying, do you have full entitlement? Do you have partial entitlement compared to your spouse? Would there be a reason that we would want to use your husband's entitlement versus yours? In your case, you had full entitlement. So you had 100% financing. As far as VA was concerned, unlimited. You could do 100% financing on a $2 million home if you wanted to. Still have to qualify for it, but you could do a $2 million home with 100% financing. And with you being the primary borrower, even though your spouse is the one who's going to have the income, you, the primary borrower, were using your eligibility and your entitlement, your VA disability allows you to be exempt from the VA funding fee. So on that loan that you're the primary borrower on, using your entitlement, no funding fee.
Which is, it was a funny conversation between me and my husband. I'm just like, we're using my VA disability and my entitlement, but we're using your income to qualify for it. And he was just like, why? Like, why can't we use mine? I'm like, because I was like, right now, according to the government, I'm more broke than you because you're still active duty. So that's why.
It's not about being broke. It's about your service to country.
Yeah.
Your disability, your service-related disability.
Yeah, it was just a good, funny conversation. As he's like, recovering from foot surgery and stuff, I'm just like, I'm more broke than you. Like, walk off that injury. Like, it's good in our house though. And then we got a comment here from Dustin about why she didn't know about this or their last 2 dang houses. And everything. And Dustin, I'll tell you. So, Michelle, how can people reach out to you or your team if they want to connect with you? To either use you guys as their loan or to talk
from an education standpoint, because who doesn't love educating?
Yeah.
The easiest way to reach me is, I'm going to make this really easy. It's PCS at caliberhomeloans.com.
I am typing this out to drop it in the comments there. So Dustin, you can reach out to Michelle. She can help walk you through everything when you get ready to buy your next home, and make sure you know all of the things you need to know. So that way now you know it for next time, and Michelle can help get you set up with all of that. No, definitely a good thing going on there. So what else? So going back to the VA loan, so we can use the VA loan more than once, right? And with that, you talked about this some about like the fee increases, but if I have a VA disability rating, do I ever pay the fee even on my second or third time using it? Like that's forever.
As long as you are the individual's entitlement, right? Mm-hmm. So it's your VA eligibility and your entitlement that we are using. Then whenever you are doing a loan, you will not have a VA funding fee. Now, in your case, right, if we had used his entitlement because he's active duty, mm-hmm. He would have been, that loan would have been even though you're on the loan, you're not the primary borrower. We were using his VA entitlement, not yours. Mm-hmm. In that case, there would have been that 2.3% VA funding fee that could be rolled into the loan, but there would have been that fee that your loan would be subject to because he doesn't have the disability. Mm-hmm. Does that make sense?
Yeah, it totally does. And then, no, go ahead and finish.
And talking about that VA loan, right? There's this misconception. And here are a couple of the myths that always make me cringe when I hear them. Because either if you've gotten the information from a lender, shame on the lender, or 2, you hear little bits and pieces here and there, and you either make your own conclusions to that. But the ones that really kill me, one is you can't use your VA until you're a veteran because it's got VA in the title, right? It's the Veterans Administration Guarantee Loan Program. So you have to be a veteran. Wrong. You can be active duty. You only have to be active today, 90 days consecutively before you become active. If they ever declare us back in peacetime, it's 180 days. Mm-hmm. At 181 days, you are of continuous service. You become eligible for the VA loan. So you do not have to be a veteran. The other one that kills me is you can only use it one time. I hear that. Well, you can only use it once, so I'm saving it. Okay, that's not true. My husband and I have used our VA loan. I say ours, right? I'm the spouse. It's kind of like ours. It's his. But we've used his VA entitlement 3 times already, and we'll use it again, hands down, for our next home that we buy as well. It is whenever you are buying your primary residence, in most cases, the VA loan, if you have that and if you are eligible for it, is absolutely always the best loan program. Mm-hmm. So you can use it more than once. If you are deployed, you can still buy a home back where your home is, right? Where either your family lives or where your command is, even though you're deployed. So there are a lot of myths out there about the ability. You can have two VA loans at the same time. I hear a lot of individuals, and there are a lot of lenders that really don't understand or don't know how to do the calculation, but you have entitlement that's available to you. And when you do a VA loan, you use part or all of that entitlement. So when you go to use the VA loan again, if you still have that original VA loan that you had, if you hadn't sold that house yet, or paid it off and done a restoration, then what happens is if you've only used part of your entitlement, so you still have part left, we can take a look and see how much you have left based on what you want to buy. And you can use that VA, sometimes 100%. Sometimes you have to make a small down payment, but it's a lot less than what you'd have to do in the conventional world. So you can absolutely have two, and in some cases, 3 or more VA loans at the same time. It just depends on how much entitlement you've used and have left.
Yeah, no, absolutely. And that's one of the things why it makes a big difference having that team that understands the VA loan, because all the little things that go with it. And if you are talking to a realtor or a lender right now and they're pushing in your military connected, active duty or veteran, and they're pushing you towards that conventional loan, I really want to strongly say to walk away and go call Michelle, because you have a VA loan for a reason. It's something we tell a lot to the real estate community. I mean, we use the military service as a way to afford and pay for things. We use it for college because we have that benefit. We use it to afford a home because we have that benefit. And so if you've got a team telling you, oh, that's too difficult or too hard or you can't do it or whatever, and you have that benefit, call Michelle. She'll help set you straight and get you what you need to do. With all of this, one thing that I didn't ask in all of these questions that I sent you, and it's something that I ask, I think, every time that we talk about housing and lending, is about refinancing. Because especially right now with the interest rates we see being 4 or 5 higher percentage, if I own a home now or buy a home now, in 2 years when it drops back down to 3 to 4%, and then 2 years after that, it drops back down to the 2% that we were all happy with.
We got spoiled.
Can I refinance each time we have that big drop in interest rates? Is it like a one and done kind of deal? Can I just repeatedly do it? Can I do that with a VA loan, or does it have to be that conventional? Like what's the deal with refinancing and using our VA loan?
And that's a great question, especially as we are in this increasing rate environment, right? We tell people all you're doing is setting yourself up for a great opportunity to refinance down the line, just knowing that if and when, we'll just say when rates come down, that you've got that ability to take advantage of that. So yes, you do have the ability to refinance with VA on I would say on the vast majority of loan programs and products that are out there, you absolutely can always refinance. So then it's taking a look. A VA loan has a unique feature in that with the VA loan, there is what's called a VA interest rate reduction loan. And that's where you are just refinancing to lower the rate or term. So maybe you're going from a 30-year to a 15-year. Maybe you're going from an ARM to a fixed rate. Maybe you're just going from a 5% interest rate down to a 3.75% interest rate when the rates drop. VA allows you to do that really simply. You do not have to re-credit qualify in most cases. In some cases, you don't even have to have your credit pulled. You don't have to document income or assets. It's just a real simple, in essence, streamline refinance process that VA allows when you're going VA to VA. VA's only stipulation is that the loan that you are in has to be seasoned. It means that you have to have had it and made 6 payments on it. So if you purchase tomorrow and your first house payment, if you close tomorrow, is July 1st. So your first house payment, let's say, is July 1st. As soon as you've made that 6th house payment, you could close on a refinance. So they just like to know, VA wants to know that you've had no late payments for 6 months on the loan that you're in before they go through the streamlined refinance process. the thing that's also really nice about that VA streamline is, unlike the VA regular refinance or a purchase that you've got that larger VA funding fee, on a streamline, one, if you're exempt, you're always exempt, so you wouldn't pay it then. But the max VA funding fee on a VA streamline is only 0.5% versus the 2.3 or the 3.6 for 100% financing on a purchase, whether you're a first or subsequent user. So
Awesome.
Nice little break there. But yes, you can refinance and refinance and refinance. Now, the thing I would tell you there is, again, working with that loan officer that you know that has your best interest at heart, because there are still closing costs that have to be paid. So then it's making sure, based on what your financial goals are and your expectation of how long you're going to be in that property, does it make sense to spend the money, increase the loan over what you have now for what you save on a monthly basis? And it's working with you to show you what the options look like so that you make the best decision, whether it's in your financial interest to refinance or not. Not that it's the lender will tell you refinance all day long, but it really needs to be your choice based on having that knowledge and information on what makes the most sense.
Yeah, no, absolutely. And I see a comment here from Dustin that says, I've always been told refinancing is bad to do. And I think Dustin and Michelle kind of cleared that up there at the end, that it depends on your situation, how long you're going to be in the home, and does it make financially sense to do that? Or if you're going to be selling it soon, maybe it's not worth it. And that's why having that that good team and that lender and that relationship that we always talked about is important, to be able to make sure it's somebody who's going to be honest with you and tell you, like, yes, you know, refinancing in your case makes sense, or like, no, maybe we hold off a little bit. If you think you're coming down on orders, let's wait until we know for sure if you are coming down on orders or if you're going to be in the home longer. Is there
are absolutely reasons to refinance, and it's a great thing to do. And there are times that it may cost you more than the benefit, and really being able to see what those options look like so you make the best choice.
Yeah, no, absolutely. We covered a lot of information today, a ton. Is there anything that we haven't discussed that families need to know about before we wrap up for the day?
The thing that I would say that is one of the conversations, especially in the last 2 years that I've had, is go in knowing what you want and being well aware in this market. Don't get caught up in the frenzy. You might decide that this isn't the right time to buy. You might decide that it is the right time to buy, but don't get in that, I call it the Vegas, that Vegas mentality where it's like that whole frenzy. Oh, I got to get it. And then all of a sudden, right, you get an offer accepted and you've waived every inspection. You've agreed to pay over and above. And now you've got the signed legal binding contract. And you're like, oh my God, what have I done?
Yeah.
Sometimes you might just need to walk away and say, I'm not going to get caught up in this, because I see that buyer's remorse. You'll always have that little heart palpitation when you get the accepted offer. Oh my gosh, this is real now. But a lot of times, if you've given up the world or you have done more than you wanted to do or planned to do, you really have a hard time swallowing that. Just be aware, go in knowledgeable, know your budget, know what you're willing to press it to, and then know that maybe you'll end up having to make 5, 6, 7, 8 offers, 9 offers, 10 offers before you get one accepted that you are happy with. But that's what's really important. It's something you're going to be making a payment on every month. And we want you to love where you live, not be stuck hating where you live because it's costing you so much more than you anticipated or wanted.
Yeah, no, absolutely. Some great words to end on. And knowing what it is that you're wanting and that you're comfortable with. I know that was a big conversation with me and my husband is where are we comfortable with where our mortgage payment would be at? Knowing what our BAH is for where we're moving to, how far over that are we comfortable paying monthly and finding a house that meets our needs, our bedroom size, our bathroom size, our square footage size, but still keeps us within that financial budget and keeping that in mind as we looked at homes and tried to decide what we wanted, what we didn't want with all of that. So definitely some good words of wisdom to end today on. So thank you for those. Thank you for everybody else for joining us today. We appreciate you sticking with us through all of this because I know it's a lot of information. It was especially if you're a first time buyer, it may all sound like a foreign language to you, like it has for me over the last few months. But having a great team between your real estate team, your realtor, and your lending team can make the difference in the process for you being able to buy a home. And again, we have the email from Michelle in the comments. You guys can go reach out to her and she'll take care of you. Again, we love the Caliber team because I know and I can tell you that they have that dedicated team specifically for our military community who get it, who understand it, who know all the details with the VA loan, to make sure you have what it is that you need. So join us back here next week on Wednesday, same time, same place. If you have a family member that is enrolled in the EFMP program or think you might need to enroll in the EFMP program, we're going to be talking with some advocates from exceptional family members who are going to come and talk about what it is that we need to know when preparing for a PCS to help make that transition smoothly between our educational services that we need from one school to the next, and also with our medical services that we may need from one installation to the next as well. So you're not going to want to miss it if you fall into that group of needing that information with the EFMP program. So join us then. Until then, y'all have a great rest of your Wednesday. Enjoy the rest of your week. If you are in PCS mode like we are, hopefully your process goes smooth. If not, let us know. We're happy to help. And follow along. You guys will see my PCS as it gets documented as we go through everything. Yesterday, we had our pre-move survey. Check the page because I did a short video after it. So you'll see it on the page down below. Go see what it's like, what it was about. If you're new, first time PCSing, I explain what that pre-move survey is as well. So stick around. It's going to be fun. It'll always be fun. I'm told it's fun. We'll see how fun it is. It'll make for a great story later, though. But we will see you all next week.
Thanks again.